Hello everyone, welcome to Strategic Management Unit number 7. In Unit number 7, we're going to be talking about, we're still continuing on their strategy formulation, but we're going to be talking about merger and acquisition. So let's jump into that. Mergers and acquisitions is a very popular strategy used nowadays, specifically by larger companies to, as we have spoken before, to diversify, maybe to expand to their market or reach new markets, and so we can say that there's very successful mergers and acquisitions. In this, for example, this video, you can see some top 10 of them, top of the larger ones, and then you'll see how it works at a glance with good examples. It's a very interesting video. They really show some good examples. So anyways, in this case, like I said, we have different intents, different reasons for doing them. So in the end, it could be to increase the market power, maybe because we want to reach new markets. We acquire companies, smaller companies in other countries. And then of course we use their operations to launch our products, or if they already have successful products, maybe we just acquire them and get their expertise. We can use it for diversifying purposes, like I said, to spread risk. So that means in this, for example, Facebook and Google have done tons of acquisitions, and ultimately what they are trying to achieve is, again, minimize their risk. They understand that their social media is not gonna be there forever, so they start to invest in maybe in the Googles. I mean, Google's like not that Facebook invests in Google in the virtual reality, in glasses and AI, WhatsApp, because they understand that their business model somehow has a lot of risk, so they have to diversify it and try to move into other directions before the time is up. And in this case, also shift core businesses into different markets, as we saw, for example, the previous unit for Samsung. No, so the core business was from trading all the way to technology. So there's a lot of changes in there. So here, the reality is that returns are close to zero. What this statement means that regardless the acquisitions are successful, they help maybe for virtual or vertical integration, they diversify, but in the end, the profits are still the same. Our operating budget is still the same as compared to our benefits is the same. So it is just like part of diversifying. We're not just gonna make double the money. No, yeah, Facebook makes double the money, but they spend double the money too. So in this case, it's more of a strategic part of acquiring companies rather than saying we're gonna make way more money. Okay, so we have here different types. So first of all, let's look at mergers. Well, there's three: mergers, acquisitions, and takeovers. And so the merger is two companies of around the same size, same capabilities. They come together to expand. Example is ExxonMobil. They realize that in order for them to have a much stronger power of the oil market, they had to come together. Is why we keep on fighting for the same resources when we can share the same resources and control at a much faster and stronger rate the oiling industry. So that's what they do. Nowadays, there's a talk of the town whether Chevron and ExxonMobil also could come together, and that's a very recent discussion. You can watch it in the video there. And so, of course, that would make a very strong conglomerate. We're talking right now that Aramco has very strong power. Aramco is Saudi Arabia. So when we're talking about Western companies, how are they dealing with the power of Aramco? Aramco is a machine that is acquiring, getting, working, and using resources massively. So the American companies are at a disadvantage in here. And again, for example, the ExxonMobil and the Chevron merger could say we are a strong competitor for Aramco and we can still remain in the market, and that is fantastic for them. We have the acquisition. Big boy acquires small boy. Why? In this case, like I said, for example, Google and Facebook. In this case, you can see here in this video the acquisitions of Google. how they have brought so much value to them. Example, YouTube. YouTube is one of the biggest and most successful acquisitions of Google, which is they brought so much revenue to them. In this case, they did brought revenue because in profit, yeah, because they bought them at a very early stage when YouTube was not what it is now. So, and that happens with many of the tech acquisitions. It's like some of them are bought at very early stages if there's a potential. So, larger companies see them and it's like, how can I get them when they are not ripe, when they are still can get a good price for them and squeeze more because I see a lot of potential. Maybe they have a unique product, maybe they have a unique process that I can benefit from, right? And then we have the final, which is the takeovers. Takeover is the receiving company. We have big company and small company. Small company is not too keen on really merging or being acquired by other company for any reasons. In this case, for example, the case of Cadbury chocolates did not wanted to get acquired by Kraft, but Kraft insisted. And there were tons of mechanisms that Cadbury tried, even by government, even by some of the investors, shareholders, and so, but in the end they couldn't. We have to understand that in the takeovers, usually a company has the shareholders. So when the shareholders, let's say we have 10, and out of those 10, 6 don't want to sell, I need to convince two of them, to make that 60% of the shareholders. In order for the takeover to happen, I need to convince them. So how can I buy their shares? Large companies try to attract those shareholders that will make a difference to final the sale. And then, of course, like I said, not everybody's happy about it, but in the end, it goes to whoever buys that majority of those shares, no? So in this case, that happened to Cadbury because it was an eternal fight. It lasted for some time, and in the end, it was a hostile takeover because they managed to get them. No? So, anyways, so the reasons for acquisition. So in this case, like I said, increased market power. We have a larger company, like I said, ExxonMobil, overcoming entry barriers. Maybe I want to go into a certain market and I cannot do it. So maybe I acquired companies that are already operating in there, and then I'm just going to put my name on top of it. But in the end, that's what I don't know. I cannot enter the Chinese market, but then acquire a company that is already operating there, and then it's easy for me to go in there. You know? We have an example of eBay and Gmarket. eBay and Gmarket is like that. It's an acquisition because in the end, eBay has much power. Cannot enter the Korean market for many reasons, or they don't have the distribution channels. And why develop distribution channels if this company already has it and I can purchase it? Because it's not substantially expensive. I still can go on a Sunday shopping and acquire this company. Okay, very good. Cost of new product development and increased speed to market. In this case, for example, the case of Peloton. Peloton creates these digital bicycles, and so in this case, what they had to do is acquire a company that manufactures the bicycles, because in the end, they were subject to whatever that company wants to do, or the time that they had to spend on producing those bicycles. So Peloton says, you're mine already, I acquire you, and then I can control my production in the most efficient way. Again, increased diversification, different companies, different markets. Like I said, Samsung, big case of it, they have diversified into many areas. No, reshaping firms' competitive advantage. Again, this is about rejuvenating our competitive advantage. Give new entries, making new flows, giving us new flows of money from different areas, and that is fantastic. And then, of course, learning and developing new capabilities. If I have new resources, how can I integrate them already to my initial resources? Those new resources, those new companies, how can they bring value? It can be in the manufacturing, it can be the logistics, it can be in many different areas. So how can I integrate them and then use them to my advantage? Now, we have, of course, we learn about the reasons for acquisitions, but we have to learn about the problems as well. And I can tell you, majority of the time, there's more problems than benefits. So here you can see in this video you can see some top 10 disastrous mergers and acquisitions that didn't work well. So many of the reasons that you will see in that video is precisely because there's integration difficulties. The operating methods, when it's a takeover, it's not so bad. When it's an acquisition, it's not so bad. Mergers are difficult because in the end is who has the control of what, no? There's, for example, the case of, it's just a very simple, no? The case of United and Continental, no? Two big airlines, and they say, okay, you're struggling, I'm struggling, let's come together. So what's going to be our name? Continental. They are similar size companies. No, but let's keep United. No, you're Continental. So, well, let's be united because we became united, right? So in the end, now they are united. So again, in this case, it's just from starting from those kind of things to financials, to human resources. You have now two CEOs and you want to narrow down all the staff, and so that's very difficult. And that is just the resources. Let's not talk about information that now has to flow, and it didn't flow before, so now it has to flow. That's a problem. Inadequate evaluation of the target. It could be that maybe we purchase a company that overpromised and underdelivered. On paper looked fantastic, but reality is not. That's the case, for example, of recently WeWork. WeWork wanted to go for IPO, and once they started to dig a little bit, whether the authorities started to dig, the financial authorities started to dig to see whether they have the right value, they had tons of debt, and then they spend money in nonsense. So the CEO used to spend money here and there, and it was not stable company. So this could be a reason, right? Again, it could be that the evaluation is like we saw this potential, but it didn't fulfill it, or they had a lot of debt. In this case, for example, WeWork, no, they were spending money on things that on the surface you cannot see, but once you start the acquisition or once you acquire the acquisition, everything pops up. And then they were hiding some of this finance. The inability to achieve synergy, again, value created by unit exceeds value of units working independently. So in this case, maybe we don't have that connection between the supply chains, the value chains. So it's very difficult to integrate them in the sense because independently they work very well, but together they don't work too well. So, and that happens also very often. Then we have too much diversification. We have too many business units and we don't know how to manage them. So nowadays, what initially a good diversification proved well, and then it creates a problem. And that's the case, for example, for IBM. IBM, and I'm going to tell you a little bit more of that story now, which is IBM started to go into so many business divisions, but they started to lose control. They started to lose competitivity because in the end, they had too many resources and they decided that actually they started to sell some of them. Right? Managers overly focused on acquisitions. Also could be too many acquisitions. There was one, what is the name of this pharmaceutical? There was this pharmaceutical, it was very famous. Give me a second, I'll tell you now. Valeant, this Valeant pharmaceutical, they started to acquire tons of companies, which they did it very strategically because they started to acquire companies that have medicines that were patents that were very unique. So they started to create a lot of value, but investors decided to realize that it was not a sustainable strategy, just acquiring another pharmaceutical rather than investing them, growing their R&D. As a pharmaceutical, you have to spend a lot of money in research and development, and they were just spending money on acquiring, and that was not sustainable over time. In the end, they failed. They bankrupted. I think they're still alive, but they have so many legal problems. Or finally, the acquisition or the merger is too large. It has too many processes, too many things that it's very difficult to get them together and work together. And again, of course, rather than creating value, generates less value because it's have too many processes that cannot be integrated. So, of course, we have effective acquisitions. Effective acquisitions, they happen when everything comes together, the assets come together. Here, your case study of unit number 7 exactly is about this. How a company is very successful in acquisitions. Cisco Systems is expert on doing that. Why? Because in advance they look at who they're going to acquire, they analyze them, they test them, they try them, and after they work with them in very, very, very many different ways, they go for the acquisition. So they have been very successful in many of their acquisitions, and of course, you have to read the case study to really understand that. Friendly acquisitions, of course, when there's no hostile takeovers, that I want to be part of you, want to be a part of me, you want to become together, and that works very well. Here, for example, the case of the acquisition of Disney and Star Wars, it started well, but it went sour already when the Star Wars movies, they didn't start to provide the profit and benefit that Disney wanted. The relationship went sour. Just now, they fired the CEO of Star Wars, well, the Lucasfilm in general. They replaced because in the end it is not what they wanted. Right? We have effective acquisitions. Again, the due diligence process of looking at all the books, the accounting, the processes, when they understand really how they work, it happens smoothly. Financial slack and also go together with a low debt position. When the companies are both in a financially healthy situation, everything works well. So that means that the acquired company is healthy, and just am I acquiring them because I have a very specific goal in terms of maybe production or so that works very well. Effective acquisitions happen also when there's innovation, when maybe the acquired company brings something new to the mother company. And of course, last but not least, the flexibility. I don't think there's more, but I think there's one more. No, the flexibility and adaptability. When companies are flexible about how they're gonna handle their processes and who's gonna go to what and which managers are going to what, how resources are gonna be distributed, etc. That also works very, very, very well. Flexibility and adaptability. New times call for new actions, and that's it. Now, when it comes to all these mergers and acquisition, we have a restructuration. That means that, well, some of the mergers and the acquisitions are, especially when it comes to mergers, mostly we integrate everything and we restructure everything. But when it comes to acquisitions, most of the time is you continue doing what you've been doing well. I'll just pour more money in you, and that's it, to grow your business, to make it better, and that you serve me as one of my parts of my engine. But again, when it comes to two big companies merging, first of all, there's the downsizing. That means we restructure all the products that we have, maybe because some of them become redundant. Maybe I have a division of, let's say for example, Unilever and Procter & Gamble come together. So we have a division of shampoos. We have to choose which units remain there because they are profitable, which ones are not, and of course we streamline which processes should be there. We also have downscoping, which is again eliminating businesses unrelated. Again, maybe we have too much diversification, but some of them are not necessary. Here's a case, for example, of IBM. IBM had that issue. They had too many businesses, and then they started to really struggle because they were not competitive anymore. The case of the laptop division, that's one. And now there's a new one. They sell again to Lenovo, this Chinese company. If I think it was servers, if I'm not wrong. So anyway, let's go for the one that I know the most, because the one other one is more recent, which is the computers. Computers of IBM, they, at least the laptops, they started to become very old. They started to have little innovation. The business was stagnant, and of course, they had a lot of knowledge. I'm not saying no, in terms of the production, in terms of the knowledge that they have, they still have good, but they couldn't focus on that anymore. So what do? They sell IBM computer computer division to Lenovo. IBM still exists. It's not an acquisition completely of Lenovo. They sell it to them, and Lenovo says, yes, I can use your distribution channels, I can use your suppliers, I can use perfect. So for Lenovo was also fantastic because they have a strategy. Actually, Lenovo has been choosing the strategy of rather than focusing on the specific market, they are focusing on the low cost. So for them, they are providing very cheap and affordable computers. Good quality ones. I'm not saying bad. I had one and it was fantastic. And then of course we have a part of the restructuration is also the leverage buyouts, which is we restructure the company because maybe when we have too many shares, many people starts to get involved in the final decisions of the company. And this is the case of, for example, Tesla. Tesla has too many shares outside, and that means the shareholders have a lot of power in the decisions that they take. They cannot just take any decisions. Tesla said, well, not Tesla, Elon Musk said the other day, what if I buy back my shares so that I can have more control over my production and my decision? It sounded like a great idea, but when you are publicly listed, you cannot just do that. You cannot say, what if I sell my shares? What if I buy them back? Well, you cannot say that because that's market speculation, and that is penalized by the stock exchange where they are registered into, which is, I think, it's Nasdaq, if I'm not wrong. So in the end, they face penalties. Elon Musk had to take a different role as a CEO because he was fired. Fired, and not because in the end he's the one, though. But I mean, you cannot speculate with the market. Anyways, the leverage buyout is again rebuying your shares because you have a specific intent for them again, and restructure your company and take actions that if you had too many investors, you cannot do it. Good. So, anyways, here we have a chart of what you want to do: downsizing, downscoping, or leverage buyout, short-term and long-term outcomes. What happens, right? So good. That's it for today. If you have any questions, you can let me know. Read your assignment of Cisco. It's a very interesting one. The more you read about it, the more you will be knowledgeable about merger and acquisitions at a successful rate. Thank you so much.